Hello guys, and welcome to My Digital Finance, the place you can keep updated on all the latest cryptocurrency news. Today I'm going to be talking to you a little bit about Bitcoin versus the banking system. So we're going to cover, the history of the banking system. If we're going to be comparing Bitcoin to the banking system, we're going to have to do a little bit of history, delving back to where banks started and where they came from, transaction fees and hacking, just comparing banks to Bitcoin and who charges, the more transaction fees, and actually looking a bit deeper into that. And also, are you more likely to be hacked in the world of cryptos or in the banking system? Returns, also your APR and inflation. That's more to do with the banks, and also the future of banking. Us that are now moving more into the technological scene with the cashless and contactless cards, negative interest rates, also looking at the blockchain technology, what's next on the agenda for the future of Bitcoin and banking, and how Bitcoin can tie into government and politics and can actually help in an economic crisis as we've seen in recent times. I'd also like to take this time to also plug in the free ebook that we've got out at the moment. The link will be below in the description. This is for anyone, again, beginners out there that want to know a little bit more about Bitcoin. This is a free ebook, about 50-page spread. Please go and download. I'm now going to take us straight into it. So I did say we're going to be going straight into the history of the banking system. So let's go a bit deeper. So when America was first being settled, there was no money system. Colonists used the barter system. Therefore, people traded for what they needed and didn't have. Trades are made in goods and services instead of money. So what does that actually mean? So that means that how were people paid, when they built the pyramid, etc. They were actually paid in food, in shelter. You weren't actually paid in physical money because it didn't exist. So if the barter system existed today, which it still does in some circumstances, if I like my friend's car, he's got a new Mercedes-Benz, and he really likes my car, a BMW, then all we'd have to actually do is exchange. That's bartering. No money is actually switched hands in terms of the physical cash, but I'm happy and he's happy, which means that really money is just an exchange of value. It's not actually the printed money we see, but we'll move on from that as we can see a little bit more. What it moved on to after the barter system is that obviously they found this beautiful product called gold. They found gold, so people used to walk around with gold to obviously purchase stuff. They turned it into little gold coins as we see today, and that's what people used to purchase things with. Now, going back to the presentation, the problem with this is what they found is, well, let's read. When money was principally gold coins, carrying it was neither easy nor safe. As a result, people wanted to store their gold in a safe place. Most often, people stored their gold coins with goldsmiths because goldsmiths had safe storage facilities. Goldsmiths were the first bankers. So you see, this is where people started to store their money. So we can see that this is where the banking system started to come from. It's not safe to be carrying around a huge amount of gold. It could be stolen, you could lose it, etc. So people would find a place to store it, which is the equivalent to a bank at the moment. It would make them feel safer. So what did that lead to? Goldsmiths would give receipts stating the amount of gold stored. People began using receipts in place of actual gold coins because it was easier to do so. People accepted the gold receipts as money because they trusted the goldsmiths and knew the receipts were fully backed by gold. I hope that is sinking in. So what that actually means is that the goldsmiths would actually print out receipts for the people that came to their store to deposit gold. So basically stamp it and say that you've got 10 you're backed by 10 pieces of gold. You've got 10 pieces of gold here. So now you can go to your butchers, your bakers, and say, hey, look, I've got the stamp of approval from the goldsmiths or the bank to say I've got 10 pieces of gold. I just don't want to carry this huge amount with me because it's not safe. And they'll go, okay. Now you can go back, withdraw 0.25 of gold or 1 ounce of gold and come back and you can buy your goods and services. Does that make sense? You have the receipt, you don't have the physical gold because that is in the bank or the goldsmiths, but you can go and then go back to them and deposit out of that as you do with the banks today. Now, then some goldsmiths began to lend out some of the gold they were storing and collected interest on the loans. However, instead of lending the actual gold, the goldsmiths gave receipts to the borrowers. As a result, there were more receipts than there was actual gold. The goldsmiths' lending activity increased the supply of money. That is, it increased the number of receipts compared with the actual amount of gold. So that means that, in essence, they started printing more money, which is what we see in society today in the banking system, is that they print more of the digital, more of the actual physical notes we see in economic society today, yet the actual amount of money is still the same, but yet they've printed more receipts. Let's move on. The goldsmiths' activity was the beginning of a process of fractional reserve banking. Under fractional reserve banking, banks are like the goldsmiths of years past. They hold only a fraction of the deposits and lend out the remainder. Fractional reserve banking is defined as a bank keeps only a fraction of deposits on hand and loans out the rest. So what does that mean for you actually with your banking system? You're with HSBC, Lloyds, NatWest. What's actually happening with your actual money? Are banks loaning out your money, or is it physically there? Let's take a look at the last slide. If you put $100 or £100 into the bank, the required reserve ratio is 10%, and this is set by the Federal Reserve. This is in America. So that means that the bank is obliged to keep just 10% of what you put in. So if you put $100 in, they're only keeping £100, let's do it. NatWest is only keeping £10 of that, physically in cash, holding it in a vault for you. The other 90%, as it states here, is used to loan. It's used for them to trade forex. It's used for them to loan out, to give on credit cards, etc., etc. They're loaning out. Now, some of you might say, what's the big issue with that? Well, it means that when you've got 50k stored in your bank and tomorrow, I don't know, you want to draw out that 50k, yeah, they've only got 10% of that. That's why they always say to you, okay, we can't do that today. If you can come back in 2 days' time, we'll have the 50k for you, because your money's not actually there. They're trading your money. Your money's not actually physically there. And that's a problem for some people, because this is what happened in in fact, we're going to go through that a little bit later, but that's what happened, in 1929, in 1980, in 2009 with the depression, with the Great Depression, or the recession, sorry, as well, is that if you're loaning out all of these things, if something happens in the market and your market takes a huge drop, people want to take their money out of the bank. Well, if people are still paying off, there's unpaid loans, etc., the bank can't actually facilitate that, which is why Northern Rock went bankrupt. And for me, that's why banks aren't 100% as safe as we see them. Now, something I wanted to move on to, or the reason I guess I mentioned this, let's move on to this first. The reason I mentioned, I guess, that particular comment is because what is money? That's the first question. People are talking a lot about Bitcoin, negative and positive, but you have to get to the understanding of what money actually is. Money isn't actually it's not the ability to store and stack up these notes, because they're not actual notes. How do I know they're not physical money? It's not the real money. It's because if you go to your £10 note, your £20 note, or your £5 note, at the top here, you'll see it says, I promise to pay the bearer on demand the sum of £10, or whatever it might be, 5 or 20. Now, why would you have to promise to pay the bearer if this is the physical money? It's because it's a promise note. It's a receipt for the amount of gold that's in the economy. It's just an IOU. It's not the physical cash itself. So what is digital money? What is Bitcoin? It's technology. It's a product. It's a product that and why people put money into it is because it's gaining them a return on their money. It's an appreciating asset. I hope that's making sense. Money isn't physically the actual the things we hold in our hand, the notes we rub between our fingers. It's actually the technology and the product. So the richest people in the world are the people that know to use money, not the people that know how to stack it. They're the people that know how to put money into other places to yield them a higher return. So I just wanted to say that, to lay the foundation, I guess, for what Bitcoin is and why we invest in Bitcoin. And for me, like I said, it's a technology, and two reasons why I guess I I like Bitcoin over, the banking system. One is because of the transaction fees, the huge transaction fees that are charged in the banking system. Just to withdraw money to put money from my credit card into my account, there's a transaction fee. To send money abroad, Western Union, there's a transaction fee. Another central authority, not just banks. eBay, someone to purchase my stuff, they take a fee. There's fees everywhere within central authorities, and that starts from the banking system, but central authorities as a whole. So we can see here, best banks in America, 2015-2016, HSBC charges a $50 monthly service fee just for having the account, which can only be waived if you keep $100,000 balance across your banking and investment. That's outrageous. You're paying crazy fees. Now, what does Bitcoin get rid of? It gets rid of those fees. I think banks in the UK, it's about 10 to 20% is more their transaction fees, whereas Bitcoin, it's actually averaged around 2%. So why is that beneficial? If I'm, a migrant worker perhaps that has come over to the UK, and that's only earning maybe $1,500 a month. I work at Costa or I work in a nearby hotel. I only earn $1,500 a month, and I've got to send my money back to another country. Maybe it's Slovakia, maybe it's China, maybe it's Ghana, wherever it might be. I've got to send back that money. If Western Union are going to be charging me 10 to 20%, 150, £300, that's actually a huge amount of money, to take out. Whereas Bitcoin, as long as I've got internet, Wi-Fi, and they've got Wi-Fi on the other end, that can be sent in a matter of 5 minutes. They've got the whole amount, or minimal fee of 2%, which is about, what's that, £30. I think that's the beauty of it. The second reason I value Bitcoin, I guess, over the banking system at the moment is because it's a central authority, the banking system, and all these other names I've mentioned, PayPal, Visa, MasterCard. They're all in one place. It's a central authority. There's one main place you can go to for all the data. We all know JP Morgan's huge building, or their main building, is in the city. All of these banks have one huge building. Their main office is in the city. So therefore, there's one point of contact if you want to go for all the data. All of these places have been hacked in the last 10 years. PayPal has been hacked in the last 10 years. We can read here, JP Morgan fell victim to the largest theft of customer data from a financial institution in US history. And that was in 2015. That's Jamie Dimon, who we know has had a lot to say about Bitcoin. But these guys are all being hacked. Home Depot Target has been hacked in the past as well. So let's move on quickly. I wanted to touch on returns. Why do I want to touch on returns? In the bank, you're probably at the moment, you're lucky in the UK if you're getting about 1% return on your money in the banks, and that's a year. So that means that if you've got £1,000 in the banks, you're lucky if you're getting, £1,010 at the end of the year, just a tenner for keeping your money there. Whereas they're spending £900 of your money, as it's stated in the presentation before, and only keeping £100 there for you. I mean, that's ludicrous. Whereas Bitcoin, you can invest from, let's go to January of this year. What was the price of Bitcoin? There we go. It was around £1,000. There we go. £1,025 on January 2nd, or dollars. Sorry, $1,025, and it's now sitting at $11,045. Where would your £1,000 be better placed? Yielding you a $10,000 increase, or earning you 1%, and at the risk of being hacked. I'll leave that to you. The truth of the matter is, actually, if you're leaving your money in the bank and you're only earning 1% on your money, inflation in the UK is nearly 3%, so you're actually losing money. Your £1,000 at the end of the year is meant to be £1,010, but it's actually really around £980 because it's minus 2% because inflation is increasing. So again, money's a technology. You've got to find ways to put it into things that are going to make you more money. What do I see as the future of I guess Bitcoin technology, banking, etc. One thing I wanted to touch on was, it was actually on BBC News. This is what I wanted to show. I'm not going to be able to obviously go through the documentary, but I advise you to go on the bbc.co.uk website and actually watch this. It was just talking about where I guess we're moving to in this contactless realm. I mean, everyone thinks it's amazing that, it's contactless and it's ease of use. I can go to the petrol station and I just tap my card if it's under £20, and it makes it easier for me. But what they've gone into in depth in this show, which I'm saying that you should watch, is the fact that it actually benefits the banks and these systems, Visa, MasterCard, PayPal, Apple Pay, is because they're actually paid the more times that you tap your contactless card. So there's even a reward system on some of your cards. You'll know NatWest, I've even got the card. They give you a 1% cash back almost if by tapping the card. So if they've got, I guess, enough money to pay me a 1% cash back, what are they earning? You've got to be asking yourself. They're actually paid. So you think that it's benefiting you, but they're actually paid the more that you're tapping your card. So just take a look at these things, because what this means is, why would they want you to be tapping your card more often? Why do they want to move away from cash? It's because cash can't be taxed. Banks don't like cash. You can't tax cash. They want to tax. They want interest. So what does that mean? If we go to a completely cashless society, if there's no cash, if it's completely all contactless, what does that mean for society? So here again, Sweden leads the race to become the first cashless society. If there's no cash in the economy, it will lead the governments, what they can start doing is actually charging negative interest rates. What does that mean? Well, positive interest rates at the moment mean that the more money you keep in the bank, they give you a percentage. If it's even 1%, you're earning money at the end of the year, for having your money there. If you take out a loan, you have to pay back, 1%, 2%, depending on what it is. That's a positive interest rate. If you have a negative interest rate, well, it's the opposite. They actually have the ability to start charging you for keeping your money in the banking system. Does that make sense? So that if you've got £1,000, they're going to charge you 2% to keep your money there annually, on top of the banking transaction fees, on top of inflation. You're going to be charged to have your money in the banking, just to have it sitting there. But it also means if you're taking out a loan, they're going to pay you for taking out a loan. Now, why is that significant? It pumps more money into the economy for them. It pumps more. It boosts an economy's GDP value, because there's more money in the economy. There's more money being spent. But for you, it's not beneficial because you're being charged. Not many people actually know how to use a loan. Many people just buy things. They go on holiday with a loan. They don't invest into assets that's actually going to yield them any more money. So that means that you're going to be taking out a loan, but paid for it, but you're not going to know what to use that loan for. Most people aren't going to know. They're not money educated, and you're also going to be charged for having your money in the account. So for me, cash is key. What happens to people that I don't know, what happens to people that get paid in cash? Builders, I don't know, someone that does home visits with their job. The only option for that person, if they do want to keep their money from the banks, is to invest in Bitcoin. That's going to be the only option for them. The blockchain technology is amazing. This is what some of these banks are even using. Some of them are saying they're against, Bitcoin. We've heard Jamie Dimon speak of JP Morgan, but now he's just come out to say that they're going to be trading that on their futures. So you've got to look deeper into these things. The blockchain technology is a huge technology, and a lot of banks are starting to adopt it and build their own technologies. And I believe Bitcoin is the future, and it's seeming that way. Everyone's moving to this, so why not get involved as soon as you can? The last thing I wanted to touch on was, I did say government and politics. I said how Bitcoin can actually help in an economic crisis. As we've seen in Zimbabwe, the current news with Robert Mugabe stepping down from his post, is that what happens in an economy like that is that their actual currency they're using in Zimbabwe is depreciating in value because of all the uncertainty in the market, because of all the political unrest. Where else have we seen this? With Brexit, the pound sterling has now dropped dramatically. Where else? In the US dollar, with Trump coming into play, you've got no clue what this guy's going to say on Twitter, or if he's going to hit the nuke to go to North Korea. So that really, really, really makes your currency volatile. So what does Bitcoin do? It actually combats that. It's actually a crisis coin, because people in Zimbabwe are putting a lot of their money into Bitcoin because it's actually an appreciating asset for them. So it's actually earning more money than it would have done if they kept it in their currency. How do I know this? If I go on Golix, I've just showed you that the price of Bitcoin on here is $11,000. Yet in Zimbabwe, they're willing to pay $18,000 for this, just because of how bad their economy is at the moment with their current currency. That is the sort of things Bitcoin can be doing you. That is why I value Bitcoin much more than the banking system, in terms of yielding money, in terms of what it can do for people, in terms of ease of use, in terms of being able to send that abroad, and it benefits my family abroad more than keeping it in the bank, more than sending it via Western Union or PayPal or Visa, MasterCard, etc. All of these things that are going to take a huge fee. And now banks are coming around to this and actually building their own blockchain technologies, which is the technology that Bitcoin is built on. Guys, if you enjoyed this video, please like and subscribe below. The ebook is also in the description below. Follow us on all social media platforms. On YouTube, obviously, like and subscribe. That's at My Digital Finance. On Facebook, at My Digital Finance Today. Instagram, Telegram, we're at My Digital Finance also. And on Twitter, also at Digital Finance 3. I hope you liked the video, guys, and see you soon.